Hello and welcome to Kemet Capital, a community of holders and seekers of African capital. I'm your host, JS, and you guys already know before we start, we begin with our word of affirmation. Our guiding principle is the Cobb and Douglas function. Guys, on our way to make Africa great again is through economic strength, economic power, and in order for us to achieve that, we need to produce more in a more efficient way. So, the topic of today's reaction pertains to the total factor of productivity, which is the change in output, not from input. All right, guys, we're going to move on to this interview from CNBC East Africa. All right, let's see what it's about, and we're going to react as we go along.
FDI in Africa has surged nearly sixfold over the past decade, but remains concentrated in natural resources. We're joined by ProParco's Deputy CEO, Jalal Khimji, to discuss how this capital can be redirected into new sectors and the latest de-risking instruments emerging from global markets. Thank you for
Great.
joining us, Jalal.
Thank you. Thank you very much.
Jalal, let's just start off with the fact that FDI has grown so much, but it stays isolated in certain extractive, natural, and resource-based sectors. What is being done right now to diversify that, to meet Africa's needs, and also to enhance its export abilities?
So,
Thank you very much. Let me just start.
so the premise of the interview is the fact that foreign capital coming into Africa, it's mostly in. Meanwhile, we want industry, we want factories to be developed. So let's see what this guy has to say.
By saying that today Proparco, which is the private sector arm of the French Development Agency.
All right. So again, before we start, let's discuss a little bit about Proparco. This guy is vice CEO or vice president of Proparco in 1977. It's a French development finance institution that focuses on private sector support in developing countries. It is a subsidiary of the Agence Française de Développement, AFD, which is France's main public development bank. So Proparco provides long-term financing and advisory services for private enterprises operating in developing countries. It means its main focus includes loans, senior subordinated and syndicated loans, equity investments, guarantees and risk sharing instruments, and technical assistance grants as well. So the target sectors of Proparco have strong development impact, including renewable energy and infrastructure, financial inclusion and SME financing, healthcare and education, agribusiness and food security. Digital transformation and innovation round up the list of sector that Proparco invest in. So let's see what Jamal has to say.
Is basically deploying around 1.5
The deep deputy
billions
CEO.
of $1 billion on the continent in various forms, either in terms of debt or in form of equity in various private companies across the continent. But you're right. The issue today is that all investment are very much concentrated on a certain number of countries only. And that's why DFI like Proparco or institution like Proparco are trying to deploy different type of tools and different goals in order to diversify their investment. For instance, we have a specific target in order to focus our investment, our action in least developing countries or in
Mhm.
fragile or conflict affected countries. This is one of the fundamental pillars of our strategy. And last year, we financed around 400 million of projects in those countries, but this is not sufficient. That's why we joined a partnership together with certain other DFIs from Great Britain, from Netherlands, in order to reach those companies which are not receiving enough foreign direct investment.
And so the tools that you
All right, guys. So for me, as Jalamal is saying, they're investing in conflict, torn countries that See, arms trafficking. Because why would you, as an investor, go to a country that's at war? Meanwhile, there are countries that are in, that don't have war, that are in peace right now on the continent. So why would you focus on those countries that are riskier, than countries at peace, but you still decide to go there and put your capital in? That means either, that conflict is suiting your interest, or you're actually fueling the country by providing weapons, stuff like that. So I'm a little bit concerned when I hear someone telling me that he wants to invest in a conflict um, torn country, especially coming from a French institution. We know how much French they thrive on, on coups on the on the continent. So for them to be specifically invested in those countries, kind of raise some red flags, at least for me. You guys will tell me what you think in the comment.
Speaking of, what shape are these tools taking that is different from what has existed with other investment vehicles that that came before to make investment in these other sectors, especially that add value to these resources or even labor in Africa?
Okay, so there are two types of tools that we are currently deploying. One is basically to provide technical assistance to businesses in order to help them improve their business model, work on their business plan, or do additional market studies.
Guys, technical assistance is critical. We need to develop our skills, we need to develop our human capital. So for us to, have important technology, it's critical for us to be able to, digest that technology, maybe improve it, but also being the future owners of the technology. Appropriate the technology to the point where we can make it run without the assistance of those foreign investors, foreign capital.
Or to reinforce their environmental and social kind of strategy. So
But no, we don't need ESG right now, guys. ESG is for mature economies like you in Europe. For us, I mean, I don't want to say we still have to think about the sustainability of our production, of our economic, the growth and so forth. But for our future, for capital to focus on that, meanwhile we have more pressing issues. That's a little bit hypocritical.
so that they are at par with other companies around the
We
continent
are not at
and they
par.
are able to attract capital. So that's why it's about investment
See, guys, this is a losing game. So if we are being, if you judge a fish by its ability to climb a tree, stupid all his life. Meanwhile, he's a good swimmer, but he cannot climb a tree. So this example just to say that if you want the capital, if you want to attract capital as an African economy, you cannot use the same tools as a mature economy that you find in Western Europe. So from the get go, it's already biased.
readiness.
Right.
The second type of tool that we are also deploying is basically to work on to provide some de-risking mechanism, meaning that we would, for instance, provide first loss guarantee to other investors in
That's actually a great initiative because as we discussed in this community a couple of videos back, people are skittish investing in Africa. It's risky. You have political risk. You know, you have there's so much that can go wrong. So to have someone that can provide some mitigating element to your risks profile, it's advantages, 100%. So for that, I'm 100% for.
in order for them to be more in a way attracted by those investments which were in which they were not doing before.
And what do the metrics show so far? I will go back to the investment readiness if we have time, but the first class guarantee that is provided to these investors who are coming into Africa, what do the metrics show so far? How successful is it for sustainability purposes?
So look, it's work in progress. What we can say today is that when we look at, for example, the private equity market in 2024 compared to 2023, we see that basically the percentage of investors from the continent in the continent is higher, has increased from
That's critical. Investors from the continent. That's actually the categories that we need to promote, and that needs to be elevated more.
around 15% to 20%, meaning that there are more local investors
Mhm.
comfortable with the local risk, and
That's
this
great.
is helped by
And guys, you see on the banner on the screen, FDI stands for foreign direct investment. So you have two type of foreign investment. You have direct. So indirect, you invest in shares of companies. So you buy a stock of, yeah, I don't know, Apple and so forth. That's an indirect investment. A direct investment, you're actually building factories. You're actually building warehouse. You're actually, uh, bringing bulldozers to the country. So you're actually bringing direct capital. So it's tangible.
some de-risking mechanism whereby either there is a DFI around the table giving comfort to other investors, or the development finance institution are providing guarantee in order to attract those
Those are
investors.
DFIs,
Right.
development
And,
finance
even the
institution.
equity market in Africa is growing. It is showing a lot more promise just in the last 5 years, and not just across the big banks and the big conglomerates,
Mm.
but also among MSMEs. How do you see that shaping the way risk models are designed right now for African businesses?
So I think that one of area of progress that needs to be little by little developed for the continent is to better understand and value the intrinsic value of a company in order for its credit risk, for its credit profile not being completely jeopardized by the credit rating of a given country.
Right.
Meaning that you can have a very good, very solid company in a particular country in Africa, which today has to borrow at a very high cost of borrowing, even if its intrinsic risk is very good. And this is because the sovereign risk of the country in which it operates is not necessarily very good. So I think that there
Interesting.
is a need to better value the intrinsic profile of a given company.
That's interesting. That's actually a great point. So let's say you have, I don't know, Dangote oil production operating company. I don't know that company. It's a solid company, providing oil, a very sought after commodity in the global market. But Dangote's industry or entity will probably be um, credit rated based on Nigeria's credit rating, which is unfair because the credit rating of Apple has nothing to do with the credit rating of the United States. So why are we being judged, on a national scale? Meanwhile, you have this entity as Jamal is saying, that is solid, a solid investment, a solid company with cash flows, with earnings that are, sustainable, that are growing. But the rating is going to be less than, it's going to be, the rating is going to be uh, based on the country's credit rate. And last week we talked about credit ratings, the need for Africa to have its own credit ratings, to have its own methodology that can be transferable, that can be applied globally. That's actually also a huge issue that we need to fix as holders and seekers of African capital.
Absolutely. I think everybody across the board agrees, and AFDB, it's one of their primary agendas going forth, is that to break the connection, the direct connection of how credit is extended to
Mhm.
African businesses from the sovereign conditions, the monetary conditions of their country at a given moment. Thank you so much for joining us, Jalal from Proparco, and sharing those insights with us.
Right, guys, short video this week. You guys let me know what you think in the comment. Proparco, are we against? Are we for? Let me know what you think, and I'll see you on the next one. Bye.